Good evening, everyone, once again. A very warm welcome to all our participants joining us today from different parts of the world, whether you're tuning in from India, Africa, or anywhere else globally. Welcome to this exclusive webinar hosted by Edubex. Today, we are diving deep into a highly critical and rapidly evolving domain in the financial sector, that is the evolution of model risk management in banking. So, to guide us through this intricate topic, we have a phenomenal industry expert with us today. It is my absolute pleasure and privilege to introduce our distinguished speaker for the evening, Mr. Ajinkya Shisode. Ajinkya is currently serving as the Assistant Director at HSBC, specializing deeply in model risk management. He is an alumnus of the prestigious IIT Bombay and brings over 5 years of core expertise at HSBC. But he has been at the forefront of retail impairment, stress testing, model validation, and governance. We are incredibly fortunate to have him share his insights and expertise with us today. So, Ajinkya, over to you.
Okay, thank you. Thank you for the introduction. Good morning, good evening, or wherever you are in the part of the world. So thank you everyone for joining this session. So today I'll be taking you through the evolution of model risk management in banking. As my introduction goes, that I have completed my bachelor's and master's in mechanical engineering from IIT Bombay, and then I moved to banking sector. And right now I'm working as assistant director at HSBC. So my primary role is into model risk management, where I validate retail IFRS 9 stress testing impairment models. So yeah, when we say model risk management, so let's first try to understand what is model risk, right? So people nowadays use a lot of times use models very easily. So for example, what comes to your mind when you hear models, right? Nowadays we use ChatGPT, Gemini, Claude, and all these type of tools, which we called large language models, right? But before generative AI, models existed long before that. So even when you are trying to predict a travel time using Google Maps, so it uses a model to predict the travel time, right? Then when you try to see recommendations on your Netflix, that is also using a model behind that. In banks specifically, we use to approve a loan or not, we also have models. So if you look at the definition of a model, so it's simply that a quantitative method, a system or approach that applies statistical, economic, or mathematical theories to transform input data into quantitative estimates. So in the banking domain, this is the definition of a model. What are the few examples we can see? So credit scoring algorithms. So you must have seen your credit score, so FICO score or CIBIL score. So all those are also determined through models. Then we have algorithmic trading models as well. So nowadays, people have algorithms to trade in the financial markets, and those are also using algorithmic trading models. Then we have macroeconomic stress testing models, and these models basically try to see what is the stress that is going to come in the macroeconomy. So what is model risk? So model risk is basically the potential of adverse consequences, which can be a financial loss or regulatory fine, which are resulting from the decisions based on the incorrect or misuse of these model outputs. So when we say financial loss, it can be a monetary loss, or when we say regulatory fines, the regulators which are there, for example, Federal Reserve, right? They can apply fine if the models are not used correctly. Now, I want to move to the historical landscape, how models have evolved from a simple calculation sheet like previously it was to a highly governed institutional assets now. So we need to understand few events in financial history to understand model risk management and how it started, what is the birth of model risk management. So this slide explains basically why MRM exists. So prior to 2008, basically before the global financial crisis, bank relied heavily on quantitative estimate models to estimate the risk. However, when 2008 crisis happened, the model failed to detect those crises. And banking majorly relies on three type of risk, which is there. One is the credit risk, that the borrower that the bank is lending the money to, they default, and market risk, where when there are a fluctuation in the rates and asset prices, and then there is a operational risk where there is a system failure. So when this happened, so then the regulators, so what are these regulators? So basically, as I said, Federal Reserve is a regulator for US. So Prudential Regulatory Authority is a regulator for UK, Reserve Bank of India for India. So these are the regulators which try to ensure that the financial system does not collapse, and they try to make sure that everything is intact. So these regulators, so USA majorly focuses on something called CCAR in the model risk management domain. And PRA has its own regulations, which is Supervisory Statement 123, which was recently published in 2023. RBI is also publishing a statement paper on model risk management. So these regulators have to ensure that the financial risk system remains intact. So how model risk management evolved? So before 2008, the models were used as simple automated calculators, right? And there were minimal independent validation. There were no governance. However, after the global financial crisis, the US Federal Reserve, they published a paper called SR 11.7, that is Supervisory Regulation of 11.7. This is jointly Fed and OCC mandated to formalize the model validation, which is independent from the development of the model. So once basically we have to build a model, so developers have to develop the model, but someone who is not in the development team, they have to independently validate those models to make sure that the models are performing correctly. And then I will, in next slides, I will also talk about IFRS 9, which went live in 2018. So IFRS here is International Financial Reporting Standards. It is used for provision calculation, and that also required model validation. And recently in 2026, the SR 11.7 paper has been superseded by SR 26.2 paper. This focuses on machine learning, AI, and it also basically removes some of the requirements that were there in SR 11.7, adds few new requirements. So it is basically the future ready paper that is there on SR 26.2. Now, why MRM is important? Because number of models in the banks have grown dramatically. And it's not just that in the bank that the number of models are going. In general, if we look at whatever we do today, we have so much data. So number of models in general are increasing exponentially. And that's why we have models for pricing, fraud, marketing, credit decisioning, capital planning, provisioning. And these small model error can impact millions of customers. So in banking, it is very much important. So model risk management exists apart from banking as well. However, it is very, very regulated in banking. And that's why it becomes a critical part of the banking sector. And that's why MRM is very critical. Now, historically, MRM has changed significantly over time. As I said, it started in after global financial crisis. So historically, validation was more of a checklist exercise, which was basically sort of a governing thing, that if validators have checked this, if they have done that or not. And we did not challenge the model itself historically. However, in the modern MRM philosophy, so we challenge the assumption. We ask what is the variable that is being selected, why is it being selected. We ask how stable is the model, what are the limitations of the model. So modern validators are not simply auditors, we are actually the independent challengers, and that is an important distinction that we have to consider. Now, majority of the work in model risk management has two pillars. One is validation, independent validation, and one is the governance aspect. So we will focus now on the validation. So what are the roles in validation? What are the processes and what are the parameters in model validation? So let's try to understand that. So these usually in large financial institution, the governance framework exists in these three lines of defense. So first line is the owners. These are the model owners. These are actually the people who build the model, who design, deploy the model, use the model. They are responsible for initial testing of the model. They are responsible for the data that is coming into the model and to document whatever they are doing. Then comes the second line, which is the MRM, which is where model risk management sits in. So here, basically, we are the independent validators. We act as objective auditors of the math, not just checking what is being done by the development team, but also checking if the assumptions, for example, if it's a linear or logistic regression assumption methodology, is the model satisfying those assumptions, right? So we have to check that. We have to independently sometimes build model to show it to the model owners that we have a better model through the same data. And then we can ask the question like why we are not using a different methodology or using a different type of architecture to build that model. And that's how we can show that there are better models that exist by building a challenger model. And then there is a third line. Third line is internal audit, which checks basically everyone is following the rule. For example, if first line is doing their job of building the models correctly, and second line, which is the MRM function, is doing the job of validating the models correctly. So that is the job of third line. Now, apart from these three lines of defenses, we also have usually external auditors, which check the work of audit as well as MRM, sometimes also the first line. And then we have regulators. So regulators set the policies and like regulations, and we have to follow their regulations. Then coming to the pillars of model validation. So what exactly do we check when we do the model validation? So one thing is conceptual soundness. So is the underlying theory like logistic regression appropriate? The mathematical assumption justified? And we check the variable selection bias. So if models are using some variables, so it is possible that the variables that are being selected are biased. And that's why the model design might not be accurate. So that is what we check in the conceptual soundness of the model. In simple terms, it just means that does the model make sense or it does not make the sense, right? Then we also have outcome analysis. So these three guiding principles were mentioned in the paper, which is SR 11.7. So that paper is still considered as the golden source for all the model risk management activities. So outcome analysis is also known as backtesting. So I think some of you might have heard this term while trading. Also, people do backtest their strategies. So this is simply comparing the historical model predictions directly against the actual observed market outcomes. So this basically means that we are trying to see how our model is different from the actual observed data. So we take predicted values, we take actual values, we try to see the variance between them. And that's how we get to know that if the model is performing well on the backtested data. And then once the model is deployed, and we have to make sure that the model does not, basically the model is accurate going forward as well. So for example, there can be a case that today all the customers that are there are not risky. Tomorrow all the customers become risky for some XYZ reason. Maybe there is high unemployment rate or something like that, and that's why the customers are becoming risky. So will our model, which is developed on the population which was not risky, work on the population which is risky? So how do we do that? We do that by monitoring. So we monitoring the model using something called population stability index, which is PSI, to ensure that our models are continue to work after deployment as well. And it's not that because of the change in the population, the models have stopped working. So these are the main three pillars in model validation. If you want to understand in MRM, then you need to understand these three things into the details, and then these are the major things that are always considered when we are validating the models. Now, as we are moving along, so we are seeing different technologies that are coming in, right? So previously we had simple Excel calculators. Then came the IFRS 9 paper. Then we had to consider the expected credit loss. We will deep dive into it in next few slides. So and apart from that, we have credit underwriting, which is the traditional underwriting, and now we are also seeing some neural network deep learning type of model. So basically, model can become complex with time, right? And we have to consider this complexity while assigning something called model tier. And what is model tier? So all models are not governed through exact same rigor, right? Because it's not possible for a bank, if it has a number of models, to give all the models same depth of validation and same attention, right? So for that, models usually are classified into tiers. So there can be, it depends on bank to banks. There can be 3 tiers, 4 tiers, or 5 tiers. But overall, the idea is that the models have to be tiered according to their complexity and their financial or regulatory impact. So, if I have to take an example, so there is something called IRB model. So, IRB model is very important to the regulators, and it has also a financial impact on the capital. So that's why the complexity of that model might be medium, but because it is very important, so that's why it becomes tier 1 model. Now there can be example of a marketing model might not be that important to regulators. Marketing model might be important to the bank because they want to market their product to the right customers. But if they don't market it to the right customers, regulators are not going to come and say that your model is not working, because they don't care about the marketing model. But that marketing model, because it has so much data, if it is using deep neural networks or generative AI, then it becomes a highly complex model. So, considering the complexity and the financial impact and the regulatory impact, the tier is decided. Usually, banks have 4 tiers, and some of the banks have 5 also. But the idea of tier is that so that we can define where we want to do in depth validation and where we want to do a base validation. So tier 1 is the high tier model where we do full code replication, extensive testing, challenger model. As I said, we build that. Tier 2 is something we challenge the methodology and we review the code, and we don't actually build any challenger model. So these are just examples, but you get the point. So tier 3 is something we just review the documentation and formula integrity for audit purposes, and it depends. Sometimes tier 3 models can also require heightened validation because of some regulators might be interested in those type of models, right? So this is how models are tiered, and the validation approaches are based on the tiers of the these models. So now let's try to look at the example of how do we actually validate those models from a IFRS 9 perspective. So before going into IFRS 9, I would like to first introduce what is IFRS. So basically, before IFRS was there, there was no a single accounting standard for all the countries, and it was difficult for to be on the same page. So basically, that's why the IFRS 9 guideline came into picture. So it's a common accounting language, and IFRS is basically International Financial Reporting Standard. It has been set by International Accounting Standards Board, IASB, and it is a standardized, high quality and transparent financial language, basically, which global companies can produce comparable financial statements so that we can compare how this company is doing, how that company is doing, if they have a same standard that they are using for reporting their balances, losses, and everything. Why it was formed? Because previously countries had fragmented accounting frameworks, and it was difficult to establish a common ground. So that's why IFRS 9 made it a standardized framework, and it was used in all the banks. Though I want to mention, still US banks, they follow something called CECL, which is current expected credit loss. It is similar to IFRS 9, but it is slightly different from IFRS 9. But whoever is in the banks that are there in UK, which are PRA compliant, they have to follow IFRS 9. So before IFRS 9, so there was, so in terms of, that was IFRS. So this is IFRS 9, which is the specific guidelines for the expected credit loss calculation. So before IFRS 9, there was IAS 39. So IAS 39 used to recognize the losses after the problem became visible. For example, a customer misses the payment, then the bank recognizes the losses. Now, this approach was heavily criticized after 2008. By the time losses were recognized, it was often too late. So that's why it was also called too little, too late. And banks recognized losses when it was already, it was not enough for the provisions perspective. Now IFRS 9 completely changed this philosophy. So IFRS 9 bring in the approach which is called forward-looking approach, which is the provisioning from day one. So in IFRS 9, bank must have to hold provisions and capitals for the losses that might happen in future. And that's why we had to predict what are the losses that are going to come, right? And that's why the modeling part came into picture for IFRS 9. So let's look at the ECL. What is ECL? Yeah. So expected credit loss. What do we mean by expected credit loss? So suppose I give you loan to 10,000 customers. Do I expect that all of them will repay as a bank? No, right? So that's why the expected credit loss concept was introduced. Expected credit loss is basically the future losses that are going to come to the bank. There are three building blocks for expected credit loss. One is PD, one is LGD, one is EAD. And this is applicable across the banking industry. So you will be hearing these terms like PD, LGD, EAD. People use them quite frequently because these are like common terms which are used in many models, not just IFRS 9 models. So what is PD? PD is basically probability of default. That is the likelihood that the customer will default. For example, if I give loan to 10,000 customers, how many of those customers are going to default? How do we define the default? Default is basically definition as per IFRS 9, it is 90 DPD. So 90 DPD, when I say, it means that 90 days past due. So your due date, for example, if I take example of a credit card, so after the due date, if 90 days are passed and you haven't paid the amount, then you'll be considered as default. So that's how default is considered. So out of how many loans I have given, how many defaulted, that is the amount that will give me the PD, which is probability of your default. Now, once a customer defaults, so for example, let's take example of home loan. Let's say someone defaults on their home loan. Now, what will bank try to do? Bank will try to take that amount and basically they will try to recover that amount. So will the whole money be lost? Maybe not. Maybe because we have the house. So that's why there will be some money that will be recovered. So that's why the loss given default is that once our account defaults, what is the loss that we are going to have? So this is basically how much money are we going to lose, right? And exposure at default is simply the total dollar amount owed at the time of default. So if you multiply these three components, then you get the expected credit loss. It is very intuitive because if you try to see that we have given, let's say, a amount of 10,000 rupees or 10,000, 100K dollars, for example, then if the PD is your 4%, if your LGD is 20%, then you can calculate, and you know the EAD value, so you can calculate the ECL value as well. Coming to secured versus unsecured. So, as I mentioned, two examples. One is credit card, one is, let's say, home loan. So, credit card is an unsecured product, while home loan is a secured product, right? So, when we are validating the models, what will be our expectation? Will credit card will have high LGD or mortgage will have high LGD? Definitely, credit card will have high LGD, right? Because it is not secured. Mortgage has collateral backing of the property that is there, right? And that's why when we are validating the model, we also check that these type of things are being considered. So we call it a rank ordering, that if credit card is more risky, then credit card should have higher LGD as compared to the mortgage. And these are the considerations we take when we are validating the IFRS 9 models. Now, uh, what does actually validator find when they are validating these models, right? So usually when we get the model, so what our day looks like. So we receive the model documentation. Model documentation has all the methodology, the data used for the model, how it is being implemented, what are the governance that are there, right? Then a model validator tries to read that document, tries to understand what are the things that are not conceptually sound, and try to question those things. Then that question is raised to the model owners. Then we have conversation with them where they try to explain us why as a model owner they think it is correct, and why as a validator we think there can be issues. So majorly what we have seen, the issues lies are in the, let's say, if the data itself is not correct, right? If there are data quality issues, that means if garbage in, then garbage out. So even if the model is very good, still, if the data is not correct, then it is not going to produce a good result, or the outcomes or the outputs are not going to be correct because the data itself is not correct. Recently, I saw a case where the model was performing really well, but there was some data issue because of the systems that were there in place. They were not correcting capturing the data correctly, and that's why the model had to apply an adjustment. What is an adjustment? So sometimes it is not possible for model to capture all the things, right? For example, there are data issues. Now we know that this is a uh, known data issue. How are we going to, are we still going to report the not correct or the incorrect ECL? No, right? So how are we going to tackle that? We are going to apply adjustments. So in that case, the adjustment was applied to correct that data issue. Now, when that adjustment was removed because they corrected the data issue, then uh, then that model output was coming out properly. Now, these type of issues, who has to identify? So, first line's responsibility is to identify these type of issues. However, if they miss any of these issues, then validators have to check if the data quality is correct. So, in that, what we check is the data actually has all the variables that are there? Are there any missing variables? What is the percentage of missing variables? Then we try to see in the data if there is any reconciliation that we can do with other sources, just to make sure that the data we are using is correct. If we cannot reconcile that data, then there is a risk that the data is not appropriate. And once we identify these issues, validators raise these issues. So these are findings that we raise, and these findings are usually locked into inventory system, which is the model inventory system. Because previously, before 2008, these were just Excel calculators that used to be there in everyone's desktop, like it was not centrally managed. But after 2008, basically it became important to have a central repository where all the models are there. So as a validator, when we find these issues, so we log them in the central inventory, and then the developers or the first line have to correct these issues. So that is where our responsibility comes in, that we have to make sure that the correct issues are being logged into the central inventory, and then we will make sure that the timelines that are there for the remediation of those issues are being followed by the first line, and they are being remediated within the given timelines. So once those issues are remediated, then the model output becomes much better. So, and in terms of IFRS 9, because we were just talking about it, so it is very important to understand why it makes more importance to MRM, because when we are publishing our annual results, for example, for any bank, when they publish their annual results, you'll see that there is always a section of expected credit loss. So you must have seen in the headlines that so bank reported so much of profit. Now, where this profit comes from, obviously, we have some revenue, we have some cost. However, we also have expected credit loss. So this expected credit loss directly affects your profit before tax. So if the ECL goes up, then the profit before tax comes down. So IFRS 9 guidelines specifically talks about the ECL values to be accurate. So sometimes when we are having a model which are capital models, then in that case it is okay to be conservative. But for IFRS 9, we have to be accurate because banks don't want to report the profit as less if the ECLs are high, right? So it becomes very important that MRM finds these issues and informs first line to fix these issues, and then we are reporting the exact accurate ECL amount, which will impact our profit before tax. So that's why it becomes very important for us to identify these issues. Then coming to some of the issues that can be there, which are like implementation errors, right? So these are my personal view is these are like very big risk, because let's say if we get the model, if the data is correct, if model is also correct, everything is correct, while implementing the model, the first line of defense or the model owners, they have not considered all the controls that should be there while implementing the model, and they made a simple coding mistake while implementing the model, right? That can completely change the result of the model. So that's why it becomes very important that we do the implementation testing as well. So first line has to perform the implementation testing, and we have to verify that the implementation testing that they have performed is correct or not. So UAT results that they produce, we check those results. After the model is implemented, we try to see if it is actually giving the output we were expecting it to give before the model was implemented, right? So considering all these things, implementation also becomes a key thing that we have to check in model validation. Then if we come to the design part of the model, this is something I think many of you must have seen in data science course or ML courses, where we say that if the model is overfitting, then it's not correct, or it's not the best model, basically. So it's similar to a student memorizing past exam papers, and it can like that student can score perfectly on the past exams. However, in actual exam, they actually struggle. Why they struggle? Because they have overfit their model. They have learned only the questions that were there in past. If they would have actually learned the concept, then the model, then maybe they would have not done as good as they would have in the past exams. However, in the actual results, they will be doing much better. So overfitting is simply that if we have the data and if we train our models, which are only working on that data and might not work on the future data, then the model is overfitting. And that is something that we check, that if a model should not be overfitting. We have few tests for that. We do those, and we try to check that. Then there comes the documentation gap. Now, let's say that the model is also built correctly, the data is correct, when the design is correct, implementation is correct. However, as a model validator, when we are receiving that model submission, we are getting the model documentation. If the documentation itself lacks the key details, it will be so much difficult for a model validator to validate that model, to understand what is actually going in that model. And then if it is difficult for model validator, then it will be difficult for validator to explain it to auditors and then eventually the regulators. So that's why the documentation also becomes a key theme that we have to check. So data, design, implementation, documentation, and then governance, which is basically if the model has proper controls, if it is actually the first line is maintaining all the records that are there related to model in a central inventory and all the stuff. Are they following the policies? So based on the regulations that these regulators produce, so maybe SS123 or SR11.7, so every financial institution have their own policies, which is the interpretation of these regulations. So we have to make sure that the models are aligning to those policies, following everything that is there in those policies. So that is also a part of model governance that we have to check. So these are the usually these are the key issues or the gaps that a validator actually finds. And basically, if you look at model risk management, we are just trying to ensure that whatever are the issues that are being missed by the first line of defense are getting captured through independent validation, because we are not involved in the development of the model. And then we are trying to make sure that the reported values that we are basically using for our annual report, so those are the correct values, and we are trying to make sure that it is independently validated. Now, what are the practical challenges that usually come in validation? So, I this is where it comes from my like personal experience that usually developers are also intelligent professionals. Like they have also invested months into building a model. So usually, if you look at a development of the model, it takes more than 6 months to develop a model. However, a validator gets 1 month to validate that model, right? So the developers actually spend so much time, and that's why it might be difficult sometimes to convince them about the validation findings that we find. So, so we have to supplement our arguments with the data, with actually showing them the analysis that a validator has done to convince them that these are actually the issues. Because sometimes it might not be the case that the model developer, they might not be very willing to accept those findings. And as we saw in the tier, there are tier 1, tier 2, tier 3. Similarly, in the findings also, we have severities for the findings. Some findings can be very severe. For example, the outputs are completely wrong, or it is not following the regulation. So those are severe issues. However, documentation gaps can be a not severe issue. So it can be a low risk issue. So when we issue the high risk findings, then developers might push back, and then we have to have back and forth with them to convince them if it makes sense. And sometimes it is also possible that they provide us with additional information, additional analysis, and additional data which was not available to us, and then we agree that it is not an high risk issue, and then we have to downgrade it to maybe a medium risk or a low risk, or sometimes close it. Then regarding the timeline, so as I was talking about IFRS 9, there is also a program, so which is called CCAR, which is Comprehensive Capital Analysis and Review, which is run by US Federal Reserve. Now, this program has a specific timeline set from the regulator. So usually it is the year end that CCAR runs. So for CCAR, we have to publish a report which is called FR14YA report. So that report also includes the validation of the model. And so basically, whenever we validate the model, when we are talking about these findings, what we are observing, we issue them in a report, because that is the final deliverable of the model validator. That is the final report which gives a rating to a model and the issues that we have identified. So these things are time bound. For example, if regulator has said that they want it in the Q1 of the 2027, then we have to make sure that those timelines are met. And because that's why, but we also have to consider that the developers also takes time to develop the model. So sometimes it happens that validators don't get sufficient time to review the models. In those cases, what we have to do is we have to understand the impact of the issues. So sometimes some issues might not be as impactful as other issues. So we have to consider on the impactful issues. So 80% of the problem comes from the 20% of the issues. So we have to identify those 20% of the issues, right? So that becomes challenging, and that is something that we have to consider. Then now another challenge that usually MRM is facing is the unregulated or the gray areas. When I say unregulated, so AI models are coming in, generative AI models have started to come in, but these are unregulated. Like the guidance on these models is very limited from the regulator side. So uh, traditional regulations that were written, they were primary for the statistical models such as linear logistic, and now it is evolving. So regulators are starting to include AI/ML section in all their model risk management papers and try to give guidance on what are the things that they will be interested in, something like explainability and bias and all those stuff. So, however, it is still a gray area, and there are no like certain rules that we have to follow. So that is also a challenging part that is coming in. Now, this are the things that are going on right now. So what is the future of MRM and what lies ahead? So as I said, traditional models were using logistic regression, right? Then came the ML models which used XGBoost, GBM, and then the deep neural network. Now basically the as the model complexity increases, the interpretability of that model and explainability of that model decreases. Now, why don't bank use all the deep learning models and to do all their provisioning? So it is simply because though those models can give better results, however, when a regulator comes, it is very difficult to explain them the models. What is the happening in the model, that it is a black box, and regulators are strictly demanding explanations, specifically the XAI frameworks, before bank can deploy these type of models. So if regulators are not convinced, then you cannot deploy the model. So that's why it is very important for us to consider that though the models will give a better result, we also have to make sure that the models remain explainable. And hence, if you ask me, till date, banks use linear logistic regression models because those are easy to explain, easy to build, and those give decent results. So, and if there are any, we identify any issues in the ongoing monitoring, or we identify some early warning indicators, we try to redevelop those models. So that is the status quo as of now. However, going forward, this might change. Maybe the AI methodologies become more prevalent, and basically the explainable framework also becomes more accessible and easy to explain to regulators. And it might be possible that the models can move to AI/ML methodologies. However, the data part is also a challenge. So in retail portfolios, the data is quite high, as you can understand, because retail portfolios have customers like us. However, the wholesale portfolios, the data is not that rich. So it is not easy to build a ML model for those type of portfolios. So I expect that first the ML models will come to retail portfolios where there is vast amount of data which can be used to build these type of models. But it is yet to come. And most of the industry, people are still using the traditional statistical models. Now, what is the next phase for MRM? So nowadays, you must have heard everywhere, like people are focusing on automation. So similar thing are going to happen in MRM as well. So what people are trying to do now is to automate the tasks that were manual. So when we are validating, so if we have received a documentation from the first line, if we have all the analysis from them, and we just want to, let's say, write a conclusion of that in our report, so those tasks can be automated. So the manual work that was there in the model validation space, those are getting automated. And some of the metrics that we calculate, those can have tools which can basically calculate these metrics easily rather than every time doing that analysis. And then the next part is the explainable AI. As already mentioned, These interpretability frameworks like SHAP and LIME are being used to explain the AI models, neural network models. And regulatory landscape is also evolving with all the model landscape evolving. So this is what is happening. However, I would like to say, though so much of automation is happening, the critical aspect of MRM is not just replicating or conducting the same test that the developer has done. MRM has, as a function, MRM has to think critically, use their business judgment and their knowledge of the portfolio and their knowledge from other models to validate the model. And those sometimes are not straightforward things that can be easily done by AI. For example, if we give a model to let's say any AI model to validate, it will do a decent job. However, the critical aspect of the model validation, which comes from the expert judgment, that will be missing in that type of validation. Hence, it is evolving. Future we will have automated tools which are doing MRM validation. However, the key will be to have that expert judgment and that business sense on where the exact issues of the model lies. Now coming to what is the career landscape in MRM. So just wanted to highlight what are the skills that are required in MRM. So these are hybrid skills. Mostly modern MRM professionals have these type of skills that are like quantitative finance. You need to know statistics, econometrics, and calculus. Then in technology, you need to have understanding of Python, SQL, SAS. Previously, we used to have many SAS models. Now most of the SAS models are being moved to Python. So yeah, I think Python is much more relevant now. And you need to understand the data pipelines, how the data flows, how data exclusions work, and which data is being used for building the model. Because when we get the code, sometimes we have to replicate it from the start. So we have to understand how. So mostly data is given by first line, but we have to understand what is the data preparation steps that they have used in that model. Then apart from that, we also need, as I said, there is a lot of stakeholder management that we have to do, which is basically with the regulators, with the auditors, with the senior management, even the model owners. So these are the things that we have to do. So I feel MRM is one of the few careers where basically it's a combination of statistics, programming, finance, regulation, and stakeholder management. This is one of the few careers where all of these come together. So I think that's it from my side. So summary, models are critical to the modern banking. Model risk management exists because models can and they do fail, as we have seen in past. Also, just to highlight here, so the when COVID came, so at that time also there was a payment holiday which was given. So when I say payment holiday, it means that that the borrowers did not have to pay for a certain amount of time. Now all the systems were not capable of handling that thing. So all the systems were showing that the account is 90 days past due, hence it is default. However, it was not actually default because there was a payment holiday given by the government. So that's why all the PDs, which are the probability of default, went up. However, it was not the true picture. When we see the actual losses, it was not that high. So these type of things come, and that's why we need models, and they do fail. We have seen from time to time that maybe COVID was a one-off case, but maybe in future there can be another case and the model can fail due to different reasons. One of the examples is also when this Middle East conflict began. So the models did not consider that scenario, right? So when we say forward-looking models, we have to consider the future scenarios, what are going to happen in the economy. So the oil prices went up. So that was not considered in the scenario. So then in the next quarter, we had to create a scenario. I mean, the model developers had to create a scenario which considered that the oil prices might go up very high. And that's why the expected credit losses can also go very high, and these type of scenarios were considered. Obviously, we give weightage to these scenarios. Sometimes it's not that 100% that same scenario will happen. Sometimes it's a judgmental call that 10% chance of that scenario happening. We have multiple scenarios Some are good scenarios, some are adverse scenarios, and these are extreme scenarios, which are one-off cases. But we have seen time to time that these cases happen, and that's why model risk management is very important to highlight these issues even before they come. And the future of MRM, as we saw it, will have AI automation, but definitely explainability will be required. Yeah, feel free to unmute and ask if you have any queries, if you want to know more about any topic. I hope the session was useful because I did not want to go into too much of technical details of how actually the models are being built. However, this was just to give you an understanding of what exactly is MRM function. If you want to learn more, you can definitely research more on the detailed topics that are there, which I mentioned in this webinar. Okay, thanks everyone. Let me know if you want to know anything more.
It was a very insightful presentation. Thank you very much. And for all the participants, thank you once again. Have a wonderful evening.
Thank you.